If you strip away the branding and, the slick product launches, a tech giant's annual report often reads like a sci-fi novel disguised as a spreadsheet.
Oh, absolutely. It's pretty wild.
Right, you're looking at these entities that give away their most sophisticated, resource-heavy consumer products entirely for free to half the planet. And yet, they generate more wealth in a single quarter than, like, some actual nations do in a year.
Yeah, and that is exactly why we're looking at Meta's Form 10K today.
Welcome to the Deep Dive, by the way. And a special welcome to you, the learner. We know you're here to cut through the noise and get straight to the underlying mechanics of how these modern monoliths actually function.
And this 10K for the fiscal year ending December 31st, 2025, it really offers the perfect lens for that. It is not just a ledger, it's an architectural blueprint of their entire strategy.
Laying out exactly where they are allocating capital to defend their current empire while, trying to build the next one. Okay, let's unpack this. Our mission today is to dissect Meta's 2025 operations. We need to look closely at what products are actually moving the needle, who is funding this operation, and what drove their massive $200 billion revenue this past year.
Right, and we have to look structurally at why that massive top-line explosion didn't smoothly translate into bottom-line net income.
Exactly. Because looking at the filing, it's just immediately obvious that we are essentially analyzing two different companies bound together by a single balance sheet.
Yeah, that dual identity is the fundamental baseline for understanding Meta's current posture. You basically have the family of apps on one side.
So that is Facebook, Instagram, WhatsApp, Threads, Messenger, and the integrated Meta AI.
Right. The software ecosystem, it represents their present. It is high margin, highly mature, and just universally adopted.
And then on the flip side, you have Reality Labs.
The hardware and virtual reality division,
Hmm.
which represents their aggressive, incredibly capital-intensive bet on the future of spatial computing and the metaverse.
So to understand the financial gravity of that present-day software ecosystem, you really only have to look at one metric in the 10K. They have 3.58 billion daily active people, or DAP, as of December 2025.
Which is practically half the planet checking in every single day.
But here's the tension I want to pull on. When you have nearly half the global population interacting with your product daily without ever entering a credit card, the traditional concept of a customer just fractures completely.
It really does.
I mean, we use the apps, but we aren't the economic engine, we are the inventory.
That is a crucial distinction. In the family of apps, the consumer and the customer are two entirely different entities.
So the consumers are those 3.58 billion users.
Right, who exchange their attention and their behavioral data for access to communication networks, entertainment, and, AI utilities.
And the actual customers are the marketers.
Exactly. The businesses using Meta's self-service ad platforms to acquire that attention, they are the ones paying.
And the friction in the 10K lies in how Meta is trying to collapse that distinction with Reality Labs. They don't just want to mediate our digital experiences through Apple or Google's operating systems anymore.
No, they want to own the entire stack.
Just look at the 2025 hardware lineup they detail.
Yeah.
You have the MetaQuest VR ecosystem, the Ray-Ban Meta AI glasses, and then those Orion True augmented reality prototypes.
And they even detail the Meta Neural Band this year.
Oh, wow. Yeah. That uses electromyography, right? Like reading the neuromuscular signals in your wrist so you can control these AR environment without a physical interface at all.
What's fascinating here is the strategic imperative behind that hardware pivot. For over a decade, Meta has been entirely reliant on the mobile operating systems controlled by their biggest rivals.
Like Apple and Google.
Exactly. They've been subject to the platform rules of iOS and Android. So the massive capital being pushed into Reality Labs isn't just about selling cool glasses.
Which they explicitly state that 70% of their 2026 operating expenses are earmarked for wearables.
Yeah, that is a staggering number. It is a strategic mandate to own the next computing platform. Because if they control the hardware, the operating system, and the interface, even down to neuromuscular inputs, they eliminate the platform risk that has historically threatened their ad margins.
They want to be the landlord, not the tenant. But, until those AR glasses are on a billion faces, the ad engine remains the beating heart of the enterprise.
It is funding everything else.
And looking at the 2025 business model mechanics, that engine is undergoing a massive AI-driven overhaul. Advertisers participate in this sophisticated auction system bidding on impressions and conversion actions.
But the regulatory environment outlined in the report paints a picture of a company actively losing the deterministic tracking data that built that engine in the first place.
Yeah, the regulatory landscape in Europe is a primary example of this signal loss.
The 10K outlines how they've had to implement the subscription for no ads model over there.
And more critically, that November 2024 rollout of the less personalized ads, or LPA option, for European users.
Right, and you combine that with all the fragmented state-level privacy laws in the US now.
So the traditional methodology of digital advertising, like following a user across the web with direct cookies to build a deterministic behavioral graph, that is just structurally degrading.
Exactly, which begs a really important question.
Right, so if they are losing data tracking, how are they still making money? How does the business not just survive, but accelerate?
The answer detailed in the filings points squarely to their proprietary Llama Foundation models. They aren't just using AI for chatbots anymore.
They're using it as a structural replacement for deterministic data.
Exactly. That is the core of their discovery engine now. When you lose the ability to track a user across the internet directly, you have to transition from a deterministic model to a probabilistic one.
So they are guessing what you want instead of knowing what you did.
But guessing with immense compute power, they analyze the contextual signals that remain.
Like how long you linger on a specific reel, right?
Yeah, or the semantic relationship between the accounts you follow or the micro-interactions within their own walled garden.
The AI Foundation models process those vast oceans of unstructured data to predict user intent with staggering accuracy.
It's a complete shift from knowing exactly what a user did yesterday to algorithmically predicting what they are most likely to do today.
And based on the 2025 top-line metrics, that probabilistic engine is outperforming the old data model. Here's where it gets really interesting.
The numbers are just wild.
In 2025, Meta generated $200.97 billion in total revenue. That is a 22% year-over-year jump.
Adding over $35 billion in new revenue to an already massive baseline in a single 12-month period is basically unheard of at that scale.
It requires absolute optimization across the board. So what drove that? Let's break down why revenue jumped so dramatically.
Well, we can disaggregate that growth into volume and pricing. The total number of ad impressions delivered globally increased by 12%.
Okay, so just more ads being shown.
Right, and a significant portion of that was driven by user growth and increased time spent on the platforms, heavily weighted toward the Asia-Pacific region.
But the more telling metric is the pricing side. The average price per ad increased by 9%.
And an advertiser doesn't just willingly absorb a 9% price hike out of loyalty, you know.
Obviously not. In an auction model, prices only rise if the return on ad spend justifies it. If you are an e-commerce brand, you're calculating your customer acquisition cost meticulously.
Precisely. And the report explicitly credits the online commerce vertical for driving this demand. Advertisers were willing to bid higher in the auction because the AI-driven discovery engine was delivering higher conversion rates.
The algorithms became so adept at matching products to high-intent buyers that the value of each individual impression inherently rose.
Which leads to a remarkable global metric.
Oh, the ARPP. Meta's annual average revenue per person hit $57.03 in 2025.
Think about the global distribution of those users for a second. Despite varied economic conditions across different continents, the algorithmic efficiency extracted an average of $57 per user.
It really is a testament to the scale of the operation. But as we pivot from the top line to the bottom line, the narrative shifts significantly. Revenue generation is only half the equation, right?
Oh, absolutely. The capital required to sustain that generation tells a completely different story.
And this is where the 10K requires some forensic reading. Because the operating income, which is the profit generated from their actual business activities, was phenomenal.
It hit $83.28 billion, up 20% from 2024.
That means the core business is incredibly healthy. But when you look at the final net income, the actual money left over after all obligations, it dropped to $60.46 billion.
It shrank year over year.
Wait, if revenue went up by 22% and operating income went up by 20%, why did the final net income go down from 2024? Where's the money leaking out?
Yeah, we need to map the three major cost drivers that created that divergence. The first major one is the sheer scale of the infrastructure build-out required to run those probabilistic AI models we just discussed.
Training and running foundation models like Llama is extraordinarily compute-intensive.
Exactly. Their research and development expenses surged 31% to $57.37 billion.
Wow.
And they expanded their technical headcount by 8%, specifically concentrating on highly specialized AI engineering roles.
But the headcount is just the intellectual capital. The physical capital required is staggering.
The capital expenditures for 2025 hit $72.22 billion.
We're talking about custom silicon, vast server clusters, and the sprawling data centers required to house and cool them.
The barrier to entry for this level of AI has become purely structural. Only a handful of entities on the planet can even afford the electricity bill.
So that is driver number one. What about the Reality Labs division?
Right. The second major cost driver pulling on those profits is the ongoing capitalization of Reality Labs. It reported a massive operating loss of $19.19 billion for 2025.
Which is an expansion of the $17.73 billion loss in 2024. It's basically a black hole for capital right now.
It is, but it's crucial to view that not as a misstep, but as a deliberate reallocation of capital.
They are taking the surplus generated by the AI ad engine and subsidizing a decade-long hardware initiative.
Exactly. Taking a $19 billion hit to operating margin in a single year to build the Orion glasses and neural bands is the price they're willing to pay to ensure platform independence in the 2030s.
It is a formidable R&D tax on their own business.
It really is. However, the third and most decisive factor in the net income contraction wasn't an operational choice at all. It was geopolitical.
Right. The 10K details the impact of the One Big Beautiful Bill Act, or OBBA.
Which was enacted in the third quarter of 2025.
Geopolitical shifts often rewrite the rules of corporate finance overnight. And, the impact of this specific legislation on Meta's balance sheet was immediate. And just to be clear, we are just looking at the financial mechanics detailed in the filing here, not taking a stance on the legislation itself.
Of course. The implementation of OBBA fundamentally altered the company's tax position.
How so?
The most significant consequence was a massive valuation allowance charge against their deferred tax assets.
Right. In corporate accounting, if legislative changes make it unlikely that a company will be able to utilize certain tax benefits in the future, they have to write down the value of those assets immediately.
Which acts as an anvil dropped directly on the net income line.
Exactly. Because of that specific legislative mandate, Meta's effective tax rate for the year skyrocketed to 30%.
To provide context, their effective tax rate in 2024 was just 12%.
Wow. That is massive.
Yeah, and the report explicitly notes that without the impact of the new law, their 2025 tax rate would have remained stable at around 13%.
So an 18-point swing in the effective tax rate is the primary culprit. It effectively erased the financial gains of a $35 billion revenue increase.
It's a stark reminder that no matter how sophisticated the algorithm or how vast the user base, multinational corporations remain tethered to the legislative frameworks of the jurisdictions they operate in.
Absolutely. But speaking of financial maneuvers, there is an accounting adjustment detailed in the 10K that is just a masterclass in balance sheet management.
Oh, you were referring to the revision of the estimated useful life of their server infrastructure.
Yes. It's a seemingly mundane paragraph, but the implications are massive.
In January 2025, Meta evaluated their server and network assets and determined that the hardware would remain viable for 5.5 years, which was an extension from their previous internal estimates.
The mechanics of depreciation are a powerful lever in corporate finance. When a company purchases physical infrastructure, they don't take the entire expense up front, right?
Right. They amortize the cost over the expected lifespan of the asset.
So by adjusting that lifespan from, say, 4 or 5 years to 5.5 years, the amount of depreciation expense recognized in any single quarter is reduced.
It's essentially financial time travel. They didn't sell an extra ad or build a new product to achieve this.
Just by recalibrating the amortization schedule of their existing hardware, Meta reduced their 2025 depreciation expense by $2.92 billion.
That single accounting adjustment resulted in a $2.59 billion artificial boost to their net income.
In a year where their bottom line was getting hammered by legislative tax changes, optimizing their depreciation schedules provided a critical multi-billion-dollar cushion.
It highlights the degree of internal estimation and structural flexibility inherent in managing a company with $72 billion in capital expenditures.
So what does this all mean? When we look at the totality of this 10K, we see an incredibly robust economic engine.
The family of apps is operating with a level of algorithmic efficiency that allows it to generate $200 billion in revenue.
It easily absorbs massive R&D bets in hardware and sudden, severe legislative tax hits. If you are an investor, a marketer, or just a user scrolling Instagram, you are fueling this massive ad engine.
And if you are a marketer, you are paying a premium because the AI is delivering conversions.
But if you are a user, you are the behavioral data powering that premium.
If we connect this to the bigger picture, Meta is using the optimized present to forcefully construct a specific vision of the future. The filings reveal an ambition that goes beyond simply transitioning from mobile screens to augmented reality glasses.
Right. The text explicitly outlines their ultimate objective, the development of superintelligence, which they define as artificial intelligence that eclipses human cognitive capabilities.
They are channeling tens of billions of dollars, not just to predict which ad you'll click, but to build an intelligence architecture designed to be fundamentally superior to the users it serves.
Their stated vision is that achieving this superintelligence will usher in a new paradigm of individual empowerment through ubiquitous personal AI agents.
It is a massive pivot.
Which leaves us with a profound structural question to consider. Throughout this entire analysis, we've maintained that the 3.58 billion daily users are not the customers.
Right. They are the audience, the inventory sold to the actual paying marketers.
But look down the timeline Meta's projecting. If they succeed in building superintelligence, and if the primary consumer interface becomes a meta-neural band interpreting your neuromuscular signals and an AI agent preempting your decisions, the dynamic shifts.
It absolutely does.
Will you finally transition from being the inventory to being the paying customer of that superintelligence?
Or when the technology moves from your phone screen to tracking your biological impulses, will you become the product in an entirely new way?
Something to consider the next time you engage with a personalized feed. Until next time.